Welcome to the Keiser Report. I'm Max Keiser. This is the pre-New Year special. Joining us in the studio to help us determine who has been naughty and who has been nice this past year is Santa's little helper, Mitch Firestein of PlanetPonzi.com. Mitch and Stacy, welcome to the Keiser Report. We've got the bubble machines going. This, of course, is significant because 2014 has been the year of bubbles blown by central bankers, part of the Planet Ponzi. Mitch, is this what's going to be the same story 2015, or is there going to be some kind of return to normality?
Merry New Year.
Merry New Year.
This is the evolution of Planet Ponzi that we're going through right now. We've gone from bubbles to bizarro. I mean, everything in the world is topsy-turvy and upside down. To give you an idea how fundamentally broken markets are, the Swiss National Bank has announced that they're going to charge you to put deposits in the bank. So not only has it gotten so egregious, there's a negative deposit rate that you're being charged to safekeep your money that they're going to lend to people at 20 or 30%. It's gotten that ridiculous. The volatility we need to talk about. We need to talk about counterparty risk and the main things going forward.
All right, let's talk about this idea of negative interest rates, because on one hand, these folks at the central planners, like in the UK, they talk about a recovery. You hear this talk also in the U.S. You hear it around the world. There's a recovery. But if you're going to negative interest rates, that implies a deflationary catastrophe, not a recovery.
I think what it implies is that there's a currency crisis and there's a lack of confidence in the system. And what's happening in Switzerland is they're printing immense amounts of money, turning it into euros, then converting it to buy stocks, pumping up the equities market to a stratospheric level.
Partly because they're maintaining a peg, right? They have a Swiss franc peg to the euro.
Yes, because what they've done now is they don't want the Swiss franc to get too strong, because it was the best currency in Europe until they said we're going to print everything that it takes, which is ridiculous. So it could really distort and destroy the valuation of that fine.
Isn't it a bit of a betrayal, because there was a referendum about whether they should put gold into the mix and have the Swiss franc partially backed by gold, and voted no. 70% voted no. And then a week later, they said, oh, by the way, we're going to go to negative interest rates and confiscate your savings. I mean, that's a bit of a betrayal by the Swiss government, isn't it?
We actually discussed that sanctioned deposit confiscation on your show. It was the first show to discuss it before the Cyprus situation.
So negative interest rates are a form of savings and wealth confiscation. So Swiss franc, the Swiss government's involved with it. The EU is involved with this also. And so is this a trend going forward in 2015, more of this type of thing?
Yes, because it's the first phase in the bail-ins. So they can't get capital any other way, so they're going to accrue more capital by creating a synthetic bail-in.
Okay, so can you increase wages by printing money?
I don't believe that you can.
It hasn't worked so far,
Well,
has
in fact, real wages are down 10% in the United Kingdom and across America and much of the Western world. Now, part of this negative interest rates is we're seeing that 2014 was the year of almost now a hot currency war, not just like a simple little battles on the currency field. It was hot currency war. We saw the ruble was a huge story of 2014. It was down 50%. Of course, the yen was down 37%, and that was good news. The ruble down is sort of bad news. And on top of that, oil, which is the global currency, really, and that was down by a remarkable amount, 50%. So what's going on with all of this?
Well, there's a combination. There's a lot of volatility right now. I mean, the world has changed. It's run by an emperor in the United States, a bunch of superheroes in the central banks, a monster, Godzilla returns to print money, and some diaper babies. So, you've got a lot of different things going on in 2014. They're talking about escape velocity. Hello, Houston, do we have liftoff yet? Have you gotten to escape velocity? With all these new terms that the central bankers have to just throw out there. But the truth of the matter...
the truth of the matter is that the people like it. People love Godzilla blowing bubbles because Shinzo Abe was reelected in Japan. You would have thought, like, the people don't like a 37% decline in their currency and bubbles all over the place, but apparently they loved it because they gave him a vast majority.
You can't taper a Ponzi scheme, but he didn't run against anybody else. That's the whole problem. When he announced the snap election, the other side didn't have a viable candidate to put forward. That's why they had the quick election.
Let's talk about oil for a second, because people assumed that when QE ended in the U.S., that we'd see some fall off in the stock market. We didn't see it. We see a rally in the stock market, but we did see a huge fall off in the price of oil. Are those two things connected? Because stock market's tied to algorithmic trading, of course. And the second question on oil is here in the UK, people are celebrating, oh, wow, I've got more money to spend and go deeper into debt this Christmas season because the price of gas or petrol is cheaper. However, they're going to lose thousands and thousands of jobs up north in Aberdeen and where the oil industry, North Sea oil, is collapsing. So once again, they're trading jobs and wages and industry for shopping and going into debt. So those are two questions about oil. So the first one is, was the collapse of QE, is that where we see it happening essentially in the oil price collapse while the stock market's held up with these Ponzi schemes?
I know you'll never believe this, but I've got some charts.
Let's check it out. Let's check the charts
Okay,
out.
so we've got, the first one we're going to look at is the Fed's balance sheet that nobody needs to worry about because it's only approaching $5 trillion and they have no exit strategy and it's 100 times leveraged. So if you had an equivalent move, actually, if you had a tenth of the equivalent move that you saw in Russia in interest rates, in the United States, they would have been bango, bust. But you can only be bankrupt. You can't be a little bankrupt. It's only bankrupt. So it doesn't matter.
They've changed that to in resolution now. Bankruptcy no longer exists. It's in resolution, and while we seize your funds.
So the central bank buys stocks,
So
not
if you look
oil.
at if you look at the central bank right now, from 2008, you can see on this chart of the U.S. Treasuries held on the balance sheet of the Fed, it just goes straight up from 475 billion to 2.5 trillion, and that's just in the Treasury bonds, and then they're also buying mortgage-backed securities. Now, there's a stealth part of this, which is QE4, which is the mortgage-backed securities. They're reinvesting everything. So they're still adding money to the system, and they're becoming the biggest owner of mortgages on the planet. So how could there be a property bubble? What could possibly go wrong? Now, to get to answer this with oil, if we put up the oil chart, the Brent crude chart from 1998 to 2004, we can see that prices averaged between 1998 and 2008, $43 per barrel. You can see this spike up. And then 2008 to 2014, when they started the QE1, you could see QE1 to QE3, $95 a barrel. And then when they really ramped up the QE from 2011 to 2014, 108 a barrel. So that's pretty interesting. And then when they stopped QE, you can see
when they taper, it caused a taper tantrum. So oil's having a taper tantrum, basically. So those charts show, here's the Fed's balance sheet, here's the oil price. They go up together. Here, the Fed stops QE. Here's the oil price. So is it just that? I mean, where's the demand? Or is Baltic Dry Index collapsed 63% in 2014. So is trade just at a standstill, or is it the QE? So many numbers are so manipulated, it's really hard to know what's going on. What's going on?
That's exactly right. Valuation is problematic because it's difficult to figure out what the real values are. GDP is down everywhere. Demand is down everywhere. As you know, iron ore prices have dropped 50%. Copper is at a 5-year low. Every commodities complex has been falling. The emerging markets, which we've discussed on your program, if we looked at Indian rupee, if we looked at the currencies in Indonesia, Thailand, all of those currencies have been coming down quite a bit because of this money printing. This is what are the unintended consequences of QE, which we'll get into in the predictions.
Okay, the money printing has not caused inflation. In fact, it's caused deflation. So some are arguing that, well, the problem is you need to print more money. Like the Paul Krugmans of the world will say that you've got to print triple and quadruple the amount of money to get inflation going. And then another side of the camp will say, well, like in my point of view, well, all this money printing is just going to support zombie banks. Unless you get rid of the zombie banks, then this money will just continuously go into a black hole and you'll never get any inflation.
Is there deflation? I mean, this is what they want, this story they want to put out. I believe that oil prices are down because demand is down. China's numbers, GDP, I mean, these numbers are all ridiculous.
That's deflation.
You can't believe any of them. However, but if you look in selective asset classes, you have almost hyperinflation. The housing market, the property market behind us. Look at how many cranes you see back there. I mean, you can't even count them. There's so many.
But that's
and the prices just keep going up when wages go down. And if you go back to the beginning of time, I've done a stat on this. In any property market on the planet, there's got to be a correlation between house prices and income. Because at the end of the day, houses and property are assets, but they're not an asset class because they lack liquidity.
Yes, but if you go back through history, we've never had a time where capital has been so free to trample around the world, and humans at the same time, immigration is much tighter than it used to be throughout history. So, the money is free to go wherever it wants and drive up asset prices, particularly here in London where there's no taxes on the property. It's capped at £2,700 a year. So why not put it into property?
Did you hear my caldera theory?
No,
Do you know around a volcano,
right?
there's a caldera.
Right.
So here, the deflationary black hole, the volcano, is sunk deeper toward the center of the Earth, but around the crust of the volcano, the caldera, you see property in London and other asset classes, fine art, et cetera, rising.
Right.
So that's how I would give a visual reference to this phenomenon of an enormous black hole. Although the price of real estate in London is going up, it's not going up as fast as the deflationary spiral is collapsing in terms of the need for central banks to take on, if you add them all up around the world, they've taken on almost $50 trillion of bad debt. Versus the real estate market in London might be up $500 billion, or the various luxury markets around the world, $500 billion versus 30, 40, 50 trillion in bad debt. So until these two things match up, we will never know what the true price of anything is.
Yeah, I mean, I think they've destroyed and distorted price discovery to such an extent that there are no real markets anymore. So if there's no price discovery, there are no markets. That's why I've created this concept of the diaper generation. So the way that works.
What is the diaper generation?
Oh, I was hoping you would ask.
We have a minute. What is the diaper generation?
We only have 1 minute.
We have a second half, so if you continue into the second half. But what's the diaper generation?
The diaper generation is everyone who is too young to remember the 1981, and we have a chart. I don't know if we can get the chart in before we break, but it's a 10-year bond chart.
Oh, that looks good, and that looks like a good moment. Remember this 10-year bond chart while you're out there getting ready for New Year's Eve.
Oh yeah, that's right. Keep the bond chart in mind. It'll cure your hangover. But don't go away. We'll be back right after this break with more hangover cures on the Keiser Report. Welcome back to the Keiser Report. I'm Max Keiser with Mitch Firestein and Stacey Herbert. We're celebrating bubbles, bubbles, bubble and trouble. Everywhere you look, there are what some would appear to be financial bubbles, Mitch. Now, we were talking about bonds before the break.
Bonds and diapers.
Bonds and diapers. Let's pick it up.
Or nappies, as they call them.
The diaper generation. So what we're looking at now, we're going to put up the 10-year chart. As you can see, it's a nice little chart. Up in the upper left-hand quadrant, you see 1568. So that was September 1981, when the 10-year bond was at 1568. So it's come straight down to 1.38 about a year ago, or 18 months ago. Straight down. So now my concept of the diaper generation are the analysts, the lawyers who are all senior now. We're not even born then.
Okay, but by the way, that's a 30-year bull market, essentially.
That's correct. That's correct. So and
interest
also,
rates have been declining for 30 years.
And the part of the diaper generation is none of these cats remember the 1987 22% decline, because they were wearing diapers at the time when the stock market dropped, as you remember, 22%.
Max still has flashbacks to that every once in a while.
In a day.
Well, when I started business in 82, 83, it was actually an energy crash. Remember, Houston was the see-through city.
Right, I remember.
So then we had a crash in 87 that you just mentioned. Then we had a bond crash in 94, dot-com crash in 2000, subprime crash in 2007. And then people were looking for a sovereign bond crash in 2014, but instead we had an oil crash. We had back to an energy crash, essentially. But is this energy crash because there's so many contingent liabilities to the price of oil, and oil is the most traded commodity in the world, and the banking industry really grew up with the oil industry because the oil industry is very expensive. It's a lot of debt financing, and it really created the banking industry, and the oil industry grew up together in a lot of ways. So if the oil industry is going back to a 30 to 40 year dollar a barrel trend, doesn't that wipe out the balance sheets of all these banks all over again? And is this going to be the prelude to another bailout or bail-in?
Well, I mean, when you see what's going on in the world and how bad things have gotten, even Warren Buffett's method of value investing, he's heavily invested in energy companies. And he's also in, he had a difficult time with Tesco and biggest shareholder at IBM. So, but he did have some dot-coms, or not dot-coms, but he had other
IBM got wiped out by Edward Snowden, essentially.
Right.
Right. I mean, that's an interesting point, is that the reveal of the NSA spying scandal crushed the overseas operations of these American tech firms like IBM, and Buffett would be suffering. And then you mentioned Tesco. Let me just take a little digression here into the Tesco, because people are comparing that to Enron, and that's a series of reveals concerning their balance sheet where they apparently, if you do the comparison to Enron, they would have a lot of their liabilities parked in special purpose entity accounts or not putting them on the balance sheet, et cetera. You are a day-to-day frontline money manager. You live and breathe this stuff. Are you hearing anything about the Tesco? Is the black hole of debt, is it going to be a story going forward and continuously reveal more of this kind of sticky debt plague thing?
A sticky wicket. Yeah,
Yes,
it's a very
yes.
sticky wicket.
What do you hear?
What I think is happening is I think you're going to see a lot of credit defaults. I think when they change the accounting rules from mark to market to mark to fantasy or whatever you like, or what they call fair value, I think people have taken it's a massive advantage of the system.
But let's compare that, Tesco, to what you were talking about as quantitative easing, is because for 30 years, interest rates have been declining. So everybody in the market looks like a genius because it's almost impossible to lose money as interest rates were declining for 30 years. At a certain point, when they're hitting 1%, there's nowhere else to go. The same with the supermarket industry, which has boomed over the past 10, 15 years, and it's been through declining margins.
Right.
And then, so they all hit the bottom, and there's nowhere else to go but fraud. That's the only way you can continue making your shareholders happy.
Well, there's one other option, which is what they're doing.
What's that?
You can borrow money at zero, buy your own shares back, less shares, price goes up, and everybody's happy.
Yes, but even that, like we've had record share buybacks, but then there becomes a certain point. So again, like I said, the quantitative easing, the Fed's balance sheet, Tesco, all these corporations around the world have to turn to fraud in order to make shareholders happy, in order to continue the shareholder sort of capitalism that we have now. Nobody but the Germans seem to do real capitalism anymore, manufacture, produce things.
Yeah, it's called fiscally responsible policy, which I don't think anybody wants to implement, because you create a problem now, and you're exactly right. But in the past 7 years, we've accrued ginormous amounts of debt. I mean, more than in the history of the planet. So, and that's in a boundary, if you go back to that chart and you look, that's in a boundary of the lowest interest rates in 300 years, that all this debt's been accrued. So that means if there's a movement in interest rates and they go up, it's bye-bye, game over in Japan, game over in the UK, game over in the US.
Hey, let's talk about Japan for a second, because Japan is kind of the what they call funding currency. I mean, this has been the place to borrow money, the cheapest of anywhere in the world. And the country is the biggest saver in the world. It's now blown through their entire savings. They have to go to the wholesale market to refinance their government debt. And their debt is now 300% GDP in Japan. It seems like Japan, if there's going to be one country that's going to blow up in 2015 and take the whole world with it, it could be Japan. Now, I heard somebody describe Japan in their debt pursuit as really consistent with the mentality of the Japanese, going back to the samurai, going back to the suicide bombers, going back to the kamikazes, that they're willing to blow themselves up to prove their supremacy in these markets, and they're on a suicide mission. Okay, what are your thoughts there?
Well, I don't know about that, but what I can say is I think that their debt to GDP is going to skyrocket above 300%. And I've got a chart on the Japanese yen, actually, that we can pull up, and it's depreciated basically 40% in the past 18 months.
But that's considered good. When the ruble goes down 40%, it's bad. So why is it good in Japan?
Well, the issue is that, I mean, what the claim is that, you know, all of the securities are purchased by the government and they're held internally, and we don't have any external debt. But they have the biggest printing press on the planet there, and they're the third largest economy in the world. I think that, you know, people, and I've seen the trolls online sometimes make comments about this show, not talking about Russia.
Whoa! This show? What?
And so, I mean, you're talking about Russia, which has a GDP, if you believe any GDP numbers, of 2 trillion. Japan has a GDP of around, they claim, around 6 trillion, and China's 9, and the US, of course, it's 16.8. So that's the differential, and that's why we're talking about.
Let's talk about, you know, you keep on saying we can't taper a Ponzi, but a good way to keep a Ponzi going is to bring new people in. Cuba is now being brought in from out of the cold. Nobody here was alive when those sanctions were first imposed. The embargo was first imposed upon Cuba.
I was.
Oh, you were? Okay, I wasn't. Fidel Castro is still alive. he lived to see the day that these sanctions end or the embargo begins to end. But if we bring in Cuba, if we bring in Iran, perhaps we could keep the Ponzi scheme going. We could pile our debt upon these people.
Exactly. Just, because but you see, they're about to shut the lights off in Venezuela. And all of the emerging markets, I've mentioned this before, all of these emerging markets are fundamentally bust right now. And look at the bad state Venezuela's in. I mean, Venezuela is still in the top 20 for GDP of countries in the world, although it is minute compared to everything. And what I think the masses and what people aren't looking at is the collateral damage and the credit risk and counterparty risk that's involved when you have a crisis in Russia or Venezuela. I mean, every corporation has credit exposures to Venezuela and to Russia and to other countries.
How about Brazil?
And right, Brazil as well. And Brazil's in the top 10.
Yeah.
So if you have exposures, how do you mitigate those exposures? And I don't know if you saw, there was the way that PIMCO had reported in its annual report, I think.
PIMCO got hit. PIMCO, the biggest bond fund in the world, or it was anyway. I don't know if they've leaked a lot of the funds. But here's a year. In 2014, we pretended there's no globalization. A lot of the news here in the UK was laughing at geopolitical tensions. But the fact is, we are a very globalized world. I think 2015, we could have the combustion of that, where we realize we actually are a very globalized, integrated world. You can't taper a Ponzi, and you can't pull out all the derivatives and where all these derivatives are around the world.
Yeah, what about the UK? Now, their debt continues to go up. The long-term debt is approaching 1.7, 1.8 trillion pounds. The deficit is still 6% of GDP, and they want to bring in more austerity, and they're really the tough austerity. They did all the easy, low-hanging fruit austerity. Now they got to do the real tough austerity where people are going to notice. In the meantime, on the high end, there's still tremendous beneficiaries from quantitative easing and the free money. So social cohesion in the UK is collapsing. There's a lot of social unrest. Where do you see the UK? Is that a trend that's going to continue in 2015?
The trend is not optimistic, because every politician wants to talk about deficit reduction. They don't want to talk about total debt. Total debt needs to be the story. But I mean, there's so much pork barrel fat spending here in the UK and in the US. I mean, nobody's really concerted. Nobody wants to take a position because special interests are at stake, which are votes. And if you bring your head above the parapet, you get shot. So why would somebody want to do that? At least you've got to give credit to the person that developed Abenomics in Japan for admitting that it's, quote, a mild Ponzi game. So, in this country, I think that the debt is going to be a major issue because it's much bigger than people think. The consumers are way overreached. Property prices are at epically high levels, and everybody's overextended. So,
and the banking system itself, the financial sector, is almost as leveraged as Ireland and Iceland were before they blew.
The big part of that is none of these stress tests that Mario Draghi, the head of the ECB, did, which these asset quality review tests, ever even considered what's happened in Russia as part of the stress. So these all need to be redone, thrown right out the window.
Let's talk about Canada, because they're very exposed to, Mark Carney left a huge housing bubble there. They're most exposed, I would say, to the oil price collapse, because they have the highest production cost of all the world. The tar sands, the oil sands, cost the most. I mean, could this be, before Japan, could this be an economy that just blows wide?
Yeah, I think Canada can be an economy that blows wide, but I don't think that their aggregate amount of debt, the total amount of debt that they have, is as dangerous as what Japan has. Because basically the way that a government funds itself is by issuing bonds. And the Japanese bond market, the only participant is printing money to buy them. So, that's a classic Ponzi, or exactly, get your bubbles out.
All right, well, we've got a few seconds left.
I've got predictions.
Oh, yeah, let's hit us with the predictions.
I'll give you seven quick ones.
All right.
Okay.
QE4.
Yeah.
Global GDP is going to collapse, and we're going to see a slowdown. We're going to see a massive uptick in credit defaults and counterparty failures and bail-ins. Greece can leave the euro. The end of U.S. dollar hegemony. And physical gold and physical silver. Yeah, boy.
Wow, awesome.
I think 2014 was the year the dollar ended its global hegemony. But you think it's going to be this year? Maybe it'd be more obvious.
Well, if you had gold in Russia, as we recommended, you would be completely hedged against this collapse.
That's right.
So that's what happens when the currency collapses. Mitch Farstein, thanks for being on the special edition of the Keiser Report.
Thanks for having me, and Happy New Year.
Have a happy New Year week.
Well, that's it for this first of the New Year's Eve week edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Mitch Firestein of PlanetPonzi.com. If you'd like to get in touch, tweet us at Keiser Report. Until next time, have a happy New Year. We'll see you in 2015.